will show you about the definition of money and functions of money. Definition of money. Money is defined as anything that acts as a medium of exchange. Any commodity that is generally acceptable as a payment for goods and services indirectly. Before the evolution of money, the system of barter was used. System of barter is an old method of exchange to directly exchange goods and services for other goods and services without using any medium of exchange like money. For example, the exchange of chicken with a dog. However, the exchange process faced a lot of problems due to the limitation of a barter system. From the 6 characteristics that were just discussed, it enabled money to perform 4 major functions that can overcome the problem of barter system. First of all, medium of exchange. What was that?
You don't know, right?
When you go to DIY, what did you exchange at the cashier if you want their correction term? What is your exchange with Hotlink if you want a reload? It's money, guys! Okay, next is measure of value at a unit of account. For this function, money can be considered as a unit of account. It's providing a common measure of the value of goods and services being exchanged. So, with knowing the value or price of a good in terms of money, it enables both of the supplier and the purchaser of the goods to make decisions about how much the good to supply and how much the good to purchase. Third, store of value or wealth. For this money function, it can make people easy to buy and sell at different times and at the different places. This means that we can use money for future spending or defer our consumption until the future. Besides, money also allows people to save as it is able to retain its value over time. Last but not least, standard for deferred payment, which means money can make us buying now and buying later, like car loan, etc. loan. That's all.
My name is Nur Azima binti Rahmat. Today I will tell you about characteristic of money. There are 6 characteristics of money. First, acceptability. Money must be accepted not only for its intrinsic value, but also as a medium of exchange goods and services. Almost any item and asset such as gold, silver, animal skin, and others have been used as money over the centuries. It is because this item functions as money and generally accepted as payment. In this modern economy, people are confident that money is tradable for goods and services. Secondly, durability. Money needs to last for a long time and should not perish quickly. Money should have the ability to be used more than one time without getting damaged. For example, when tobacco was used as money, it was perished even before the buyer reached the seller to buy goods. In these modern days, money is made out of paper, metal, plastic, which make money long-lasting. Third, divisibility. Money must be easily divisible into small units so that people can purchase goods and service at any price. For example, RM100 ringgit. It can be exchanged for smaller units such as RM50 ringgit, 20 ringgit, 10 ringgit, 1 ringgit, 5 ringgit, and fully to even smaller unit. Fourth, portability. Money must be easy to carry around. When people purchase goods, they need to bring along their money. Hence, money must be portable. In olden days, people carry around golden, silver, each burden them. 5. Relative scarcity. Money must be relatively scarce and hard for people to obtain it. Also, the supply of money same way in design, unlike cows, which come in many sizes and shape. For example, small size of cow costs Rm 4,500 and larger size of cow costs Rm 5,000, resulting each cow having different value. So, cows cannot serve as a uniform form of money. That's all.
I am Yvonne Erica Frankie. I will show you about the supply of money.
Bank Negara Malaysia defines money into three measures, which is M1, M2, and M3. M1 is narrow money. It can be used directly for transactions. It is the narrowest definition of the supply of money and it comprises the most liquid assets, which is either cash or money readily changed into cash. The most liquid assets are coins, notes, and demand deposits at commercial banks that are readily convertible into cash. M1 consists of, first, the currency, which includes the coins and the paper money. These coins and paper money are called fiat money. And the second one is the checkable deposits or demand deposits. This is the checking account or current account balances kept in commercial banks that are convertible into cash on demand by issuing checks. Secondly, M2. M2 is the sum of M1 and near money. It is broader and less liquid definition of the money supply. It functions as a store of value and part of our wealth. M2 consists of 7 components, which is first, M1, second, savings and fixed deposits in the commercial banks, third, negotiable instruments deposits. This is the document in the promises payment to a specified person or assignee. And fourth, the negotiable certificates of deposit, for example, the short-term interest-bearing debt. And 5, the Bank Negara Malaysia certificates. And 6, the repurchase agreements. And lastly, the foreign deposits in commercial banks or Bank Negara Malaysia. M3. M3 is also known as broad money. It is the broadest definition of the supply of money with the lowest liquidity. It is used by the economists to estimate the entire supply of money within an economy. M3 consists of 4 components. First, M2. Second, savings and fixed deposits in other financial institutions. 3. The net issues of negotiable certificates of deposits in other financial institutions. And lastly, the repurchase agreements in other financial institutions. Thank you.
Hi, my name is Adi Anajitwil. Central Bank, or commonly known as Bank Negara Malaysia, BNM in Malaysia, is a semi-independent government authority that provides financial and banking services for the country's government and commercial banking system. The central bank generally performs the following functions, which are: first, issuing and managing the country's currency to ensure currency stability. Printing of paper currency is one of the most important functions of the central bank. A central bank is the only financial institution with authority to issue and manage currency to ensure its stability. Next, acting as the banker and financial advisor to the government. Central bank acts as the banker and financial advisor to the government on all important financial matters of the country. They keep the government principal bank accounts, receive taxes and other revenues, and make payments in respect of government expenditure. Overseeing monetary policy is also the function of the central bank. Central bank supervises money market operation to ensure low inflation and full employment through managing interest rate and setting reserve requirement. Low inflation creates greater economic stability and preserves the value of money and saving. In addition, central bank is a bankers to the banks. The central bank keeps cash reserve of commercial banks and acts as the custodian of the cash reserve to the support and credit and banking system. Last but not least, central bank is lender of last resort to commercial banks and the government. A central bank acts as a lender of last resort to the banking sector if banks get into liquidity shortage during financial crisis. It will lend the commercial bank sufficient funds to maintain the public confidence in the banking system. Thank you for listening.
My name is Muhammad Kamarul Asfar bin Qasim. So today I would like to explain the monetary policy, which the types and the tools. So monetary policy refers to a policy used by the central bank to control the supply of money as an instrument of achieving the ultimate objective of the economic policy, which is the stability of the price or low unemployment. So the first one is the expansionary monetary policy, which is aimed to increase the money supply in the economy. It is used by the central bank to control the unemployment during the recession. This is when the central bank buying the government security and bonds through the open market operation and decreasing the required reserve ratio and in decreasing the bank rate. So the next one is the contractionary monetary policy, which is aimed to decrease to control or decrease the inflation. So this instrument used by the central bank by selling government bonds through open market operation, increasing the required reserve ratio and increasing the bank rate. The next part is the monetary tool, which is used by the monetary authority to control the aggregate demand by controlling the supply of money, cost of money, and the availability of credit. This instrument can be divided by two parts, which is the quantitative and the qualitative. The quantitative monetary policy tool are used to control the quantity of credit through commercial bank. The first tool is open market operation, which is the most effective tool used by the central bank. The central bank will buy or sell securities to the open market and to influence the size of deposit. When there's inflation in the economy, the central bank will sell securities. Therefore, it will reduce the bank deposit, and with this, commercial bank lend less to the business. Money supply will drop, interest rate will rise, and investment will decrease. The tool is the bank rate or discount rate. The bank rate policy (BRP) is the most important monetary tools to influence the quantity of credit in a country. The bank rates or the discount rate is the rate of interest which a central bank will charge on the loan and advance to a commercial bank. Whenever commercial bank have a shortage funds in their bank, they can borrow from the central bank via the bank rate or discount rate. Changes in these rates will cause changes in the market rate of interest, and this can affect the cost of loan.